Okay, welcome to the July 26th edition of the Fats, Fuels, and Oils webinar. And this week, we're going to talk a little bit about vegetable oils and go through our normal biofuel stuff. This week, there hasn't been a ton of statistical data or anything that's come out in the past week. And so I'm going to focus sort of my typical initial ramble on changes in the weather pattern and what that implies for prices going forward. I think last week or maybe the week before, I had talked about how the weather pattern had gotten better, and one of the best ways to produce a good yield for soybeans is to kind of stress the crops a little bit early and then pour a bunch of rain on them in the pod filling stage of development, which typically occurs in sort of the last couple of weeks of August and in the beginning of September. And the weather pattern at that point looked like it was shifting from one that featured a ridge of high pressure over a part of the U.S. and above average temperatures to one that featured a weaker ridge and what meteorologists call more zonal flow. And we'll actually look at some weather maps here in just a little bit, and I'll kind of show you what I mean. However, that now has changed again, and now the weather maps are suggesting that early in August, the ridge of high pressure is going to come back, and it's going to be centered basically in the northwestern portion sort of the Corn Belt, bringing hot temperatures and restricted rainfall to much of the Midwest. Now, the weather forecasts go out for 15 days, or the weather maps go out for 15 days. And so the market is obviously worried about this trend continuing through August and reaching the pod filling stage for soybeans, but we haven't quite gotten to that point in the forecast yet. Nevertheless, soybean prices had come down a bunch. They've rallied quite a bit over the last week or so. What hasn't happened is you haven't seen a sort of a similar move in soybean oil prices. And so soybean oil prices continue to kind of consolidate around the 60-cent level. And the oil share has fallen. The oil share for the benchmark contract has fallen down below 40% for the first time in a really long time. I don't think that oil share can stay below 40%, given what we think about the growth in renewable fuel or renewable diesel capacity and the demand for feedstocks going forward in the limited supply of fats and greases that are available. At some point, it still seems like oil is going to have to move up relative to soybean meal to a level that means that crushers need to match crushing volumes with oil demand rather than with soybean meal demand, which is what they have done historically. That means that while you haven't seen a move up in soybean oil prices, there is probably, as soybean prices continue to move higher, there's probably more upside risk in oil prices, soybean oil prices specifically, and biofuel feedstocks more broadly, because of where oil share is. And it could be sort of a spring-loaded rally that happens relatively quickly. Like I talked about last week, I think most of the reason that you've seen the decline in oil prices, in addition to sort of generally beneficial growing conditions throughout the summer, and that shift in the weather pattern to what looked like a more favorable weather pattern, has been the liquidation of the speculative position. And I'm not sure that oil share or soybean oil prices can really rally significantly until specs come back into the market and decide that that being long oil share is where they want to be. It doesn't mean that soybean oil prices can't move higher, but in order to get sort of a big jump in soybean oil prices, the spring loaded rally, you would need the participation of specs, and so far they do not seem interested in doing that. That may be due in part to the fact that palm oil prices continue to remain well off their highs, and they've kind of consolidated around this 3,800 ringgit level. Beyond that, the demand for palm oil from an export perspective, at least for Malaysian shipments, has been relatively weak, and so that may indicate that the tailwind that the soybean oil market has had over the past 18 to 24 months, or at least for sure coming out of the pandemic, of relatively bullish world fundamentals, is starting to wane a little bit. I tend to think that the situation in palm oil and in Malaysian palm oil exports in particular is a little bit more of a function of what's happened in Indonesia with the ban, and then the lifting of the ban, and now this week they've issued export permits for 3.8 million tons of palm oil, and I think that's taking away a bit of the demand from Malaysia. And so focusing just on Malaysian shipments probably doesn't give us a great picture of the overall demand for palm oil, but that's what the Malaysian palm oil market tends to focus on. And so in addition to this lack of sort of speculative positioning, you also have the spread between soybean oil and palm oil continuing to hover around the 20-cent level, which is kind of it's not the upper limit, but it's historically high, and it seems at this point to be about as high as that spread wants to go. And so it becomes tough for soybean oil prices to really rally and stretch that spread even further, given the fact that palm oil prices don't really seem to want to move that much higher. Okay, so let's take a look at some weather forecast maps, and bear with me because this map, if you're not used to looking at these maps, it can not look sort of very straightforward to begin with. But this is a map of the 500 millibar pressure, and sort of, if you think of the atmosphere as a bunch of layers of pressure, the 500 millibar maps are at a certain level of the atmosphere, which is about where the jet stream is, more or less. And this is what meteorologists use to forecast from your local forecast to broader forecast like we use in agriculture. And this is the map from this morning. They run these models 4 times a day at 6, 12, 6 again, and then midnight. And this is valid for Thursday, August 11th. And the important things to note here are these blue lines, which I know are kind of hard to see. But if you'll note sort of this really big blob of blue line kind of in the middle over most of the United States, that's the high pressure ridge that is setting up. And the other thing to notice is, and these are even tougher to see, but there's one here, there's this 588 number, and that tells you what the pressure is at that level in the atmosphere. Now, why is all of this important beyond the fact that this kind of shows us what what we think about the weather. There's a couple things that really you want to pay attention to if you start to look at these maps. And one is that, just as a very general rule of thumb, if you take the last two numbers of the 588, that will give you the temperature in Fahrenheit on the ground. It's not always that straightforward, and it doesn't mean that it's going to be 88 degrees between that line and the line that's next to it. But it does give you a general guideline, and the temperatures generally are within sort of 5 degrees one side or the other of that number. More importantly, those numbers and these lines dictate the temperature relative to other places. And so underneath this line, which underneath the big blob, which is a 590 millibar line, you can assume that temperatures in that area are probably going to be somewhere in the upper 80s or lower to mid 90s. Now, the other thing that we want to pay attention to here, and if I rewind this a little bit, is the positioning of that high and whether it moves around a lot or it doesn't. And I guess if I do it this way, if we kind of go back for a ways, you can see this is for tomorrow, tomorrow night, I guess. You can see this low brings rain down into the Midwest, and you can see a very different pattern where you don't really have this big blob sitting over the middle of the US. But as you start to go forward now, and that storm system moves out of the way, then you start to get the establishment of the high, and it kind of forms out here over California, jumps around a bit, and then slides to the east. And so now here you've got this 594 millibar blob that's centered over Oklahoma, and you can see that the next line is the next closest line to it is relatively far up in the country, almost to the Canadian border. And as you go forward, that high pressure ridge tends to remain relatively stationary there. This is Thursday, August 4th. And while it moves around a little bit and changes a little bit, in general, it remains over the center of the country. And so the things that you want to pay attention to on these charts are, one, sort of the intensity or that number, that 500, 590, 594, 588, whatever line, how intense is the ridge of high pressure? And then two, is it relatively stable or does it move around a lot? We sort of always have these ridges of high pressure during the summertime, which is why, in part, why it's hot in the US in the summertime, or it can be. But a lot of times it'll tend to move around, and it'll form over the Midwest or over the Corn Belt, and then it'll kind of retrograde out to the mountain areas, and then it'll kind of slide back into the Corn Belt. And when that happens, what happens is, if we go back to our forecast for Wednesday, you can see kind of the ridge is over here off the west coast of the US, and you can see this low kind of slides down the eastern side of the ridge. And generally on the eastern side of the ridge is where you get rainfall. what I tend to think of is that it generally rains somewhere between sort of the 588 line and the 580 line, depending on whether you have a storm system like this, or it just is kind of, if there's not a closed off load that's moving across the country and you just have a ridge of high pressure, the difference in the pressure gradients between 594 and 588 or 582, generally that's the area where you get colder air lifting up, and then or warm air lifting up as it rises in the atmosphere and cools, then rain precipitates out of the air and falls to the ground. And so if we go back to the end of this, you can see that those lines are way up in Canada, and there's not really a lot of chance for rain in the Midwest. And so not only do we have a relatively intense ridge that gets set up, but also we have one that's not moving around a whole lot during the forecast period, and it is leading into the most critical development period for soybeans. Now, all of this could change tomorrow. The maps have been relatively consistent over the last 4 or 5 days, which gives meteorologists more confidence in in at least the broad strokes of the weather forecast 15 days out. 15 days out, you know what weather forecasting accuracy is as well as I do. But when you do see maps that don't tend to change a lot, and you have a setup that's kind of like this, where you have a ridge that tends to be stationary, that's a pattern that if it continues on the maps, tends to verify as you get closer to the forecast date. So as we move through the next couple of weeks, I would say that the way that these maps are set up means that there's a better than normal chance that this will verify and that we will have a ridge. Now, the details are unlikely to be exactly as they're pictured today, but the general trend is there. And so what does that mean? The other thing I can show you is the 6 to 10 temperature day outlook for the US, which again shows really above average temperatures for the Western Corn Belt and at least the southern part of the Northern Plains, or the Northern Plains a little bit more broadly. If we look at the 6 to 10 day precip, again, you see not a lot of rain underneath where that ridge is, but the rain on the sort of the western side of that ridge, or the eastern side of that ridge, is where they expect above average rain. And then if you look at the 8 to 14 day forecast period, this is getting closer to what we were just looking at on the map. You see again a big area of above average temperatures centered right over where we grow all the crops. And similarly, for the precip outlook, you get really dry weather over portions of Iowa and Illinois and Missouri, which are all really big soybean producing states. So that's a very big risk for not only soybean prices, but again, soybean oil prices. However, I think we need to keep in mind what's going on in the palm oil market when we're talking about what's going to happen in soybean oil prices. And we need to continue to pay attention to what the speculative community is doing when thinking about soybean oil prices. As a result of that, I haven't really changed my forecast this week. That's due, quite honestly, in part to the fact that I just changed it last week from one that suggested higher prices over the next couple of months, in part because a couple of weeks ago, it looked like we were going to have this ridge, and then the ridge went away, and now it's back again. And I really hate sort of flip-flopping back and forth. And this call gives me an opportunity to explain why I do or don't change my forecast. And so what I would say is, while I've left my forecast unchanged this week, by the time we get to next week, if the ridge is going to verify, and if those forecast maps haven't flopped back to sort of a more zonal flow pattern, which doesn't feature a big blob of high pressure over the middle of the country, then my forecast, I think, is probably okay. If we do get that ridge, and by next week our forecast will be out through the middle of August, so into the very beginning of the pod filling stage for a lot of the crop, then I probably will shift my forecast back to one that features higher prices at least through harvest, and then probably comes down a little bit after harvest, just due to the typical seasonal impact on prices that we get during harvest. Now, again, my forecast probably will be tempered by what I think is going to happen in palm oil, and whether the slowdown in Malaysian palm oil shipments really reflects sort of a broader lack of demand for vegetable oils, or is more a function of the fact that Indonesia kind of was out of the market for a little while, or at least out of the market, at least Indonesian exporters weren't shipping at full capacity, and are starting to come back to something that is pretty close to full capacity. That will make a big difference. And even if I do adjust my soybean oil price forecasts higher, I think it's going to be tough to adjust them higher in a way that takes that spread between soybean oil and palm oil much above 25 cents. Now, last summer we hit 30 cents, but that was kind of the peak, and it's not like that spread stayed there for months and months and months on end. We kind of touched 30 cents, and then the spread started to come back down. This year is a little bit different. We've been at pretty elevated levels for quite a while, and we've been around 20 cents for several weeks at the very least, and probably more like a month. And so that means that spread is probably going to stay above its long-term average, and it may have the ability to hold at around something that's closer to 25 cents than it is 20 cents, or at least has a better opportunity to do that than I would have thought a week or so ago. So if I'm constrained by the spread, that means that I'll either need to raise my palm oil price forecast to limit this, the movement in the spread, or I'll need to limit the increase in my soybean oil price forecast to keep the spread at around 25 cents. Which one of those I do will depend a lot on, in part, what production and exports out of Malaysia, the final estimates for production and exports out of Malaysia that we get from cargo surveyor data, and from the production estimates that we get every 5 days, and in where Malaysian exports are going, the destinations. So if China and India start to step in and buy a bunch of Malaysian palm oil, I think that will mean something entirely different than if Malaysian palm oil exports are kind of not down that much, but it's just kind of scattered across a bunch of countries, and it doesn't look like the big importing countries are taking advantage of this price break and starting to restock. And I think whether that happens or doesn't happen will depend in part on what the outlook for the world economy is. Obviously, we get US GDP on Thursday. I think that's going to give us some insight into at least what's going on in the US economy, but maybe a little bit more broadly what's going on in the world economy. And that probably has an impact on whether Chinese buyers and Indian buyers are willing to step up and restock even at the lower prices, or whether their demand is off as well and they don't necessarily need to restock even given the decline in prices. Okay, with all of that said, let's look at biodiesel. So we got the data from the EPA's moderated transaction system on Thursday, and in general, both domestic biodiesel production and domestic renewable diesel production came in a little bit below our expectations. Biodiesel production was about 5 million gallons below our expectations, but renewable diesel production was substantially below our expectations. As a result, we did end up cutting our biomass-based diesel production forecast pretty substantially. I think we cut biodiesel by maybe like 20 million gallons, but I think we took about 100 or 110 million gallons out of our renewable diesel production forecast. And that's not necessarily due to any change in our outlook for renewable diesel capacity or any doubt about where production is, or what the mandates would imply about how much production we need. But there's always a little bit of uncertainty about that number that the mandates imply we need, and the RIN bank and how much of the how much obligated parties will either add to or draw down that RIN bank in any given year. And so if you think about it like this, we start with a relatively clean sheet each year, and we get the mandates, and then we calculate what we think those mandates imply, or what the mandates essentially do imply for renewable diesel and biodiesel production throughout the year. And then we start to get data, and that data generally follows a seasonal pattern that we've talked about and that you can see in this chart, where production in January and February is typically relatively low, and then you start to build through the year and you're kind of flat with some monthly variation, and then in the last couple of months of the year, production typically peaks. And so after we start with sort of this clean sheet and we forecast out for the year and we start to get data, then we start to adjust our forecast, our monthly forecast, to try and maintain something that looks like the typical seasonal pattern. Now, this year's it's a little more difficult to do that because for a couple of reasons. One, we have this big ethanol gap, or the big gap between ethanol production and the implied ethanol mandate that we've talked about quite a bit. And the other is we have this big growth in renewable diesel capacity, which means that the split between renewable diesel and biodiesel isn't going to be as clear right now as it is in the typical year, or in the year when we weren't anticipating a big expansion in renewable diesel capacity. But two, it can have a big impact on just the overall level of production, particularly given the fact that we assume that there's going to need to be a lot more biomass-based diesel production to meet the gap in ethanol production. And so that's why sometimes you will get these big adjustments in our biodiesel production forecast or our renewable diesel production forecast. Especially this year, it doesn't necessarily mean that we think that there's some big change. It just means that whatever we're forecasting for the year, the data that's come in throughout the first 6 months or whatever has fallen above or below that to an extent that you need to make an adjustment to kind of get overall output back into what you think is sort of in line with the historical seasonal pattern. And so that's kind of what we've done. We still have production that we think will grow pretty substantially through the year, and we still expect renewable diesel capacity to rise through the year. But the one thing that this change did is it kind of flattened renewable diesel production out through the end of the year. We've gotten, I think we talked about, I think last week or the week before, we talked about capacity utilization for renewable diesel in the EMTS data and the EIA data. So EIA gives us renewable diesel production capacity, and then obviously the EPA gives us what they think monthly production is, or what they report monthly production. And if you look at those numbers, you can kind of come up with a capacity utilization rate. And the capacity utilization rate for renewable diesel in May was really, really low, around 65% or something. And so that also brings in some uncertainty into whether, even if we get this big expansion in renewable diesel capacity, if the capacity is going to operate at 65%, which is a number that I wouldn't have guessed we would ever see, then renewable diesel output is going to look a lot different on a month-to-month basis than capacity is going to look. I would expect that as we refine our forecast in the coming months, we probably will get back to a renewable diesel forecast that looks a little bit more like the increase in capacity. But right now, this is kind of where we're at. And until I think we get another month or two of data from the EIA and the EPA, and can kind of see what capacity utilization looks like, and how much more renewable diesel capacity is going to come online this year, then I think we'll probably have some more confidence in our renewable diesel forecast on a monthly basis. On an overall basis, and in the trend in renewable diesel, that's very easy to forecast. Obviously, renewable diesel production is going to rise pretty significantly from last year to this year. But given, again, what we saw in capacity utilization in last month's data, and then also I think given what we've seen in our assessment of biofuel margins, that's also something that's giving me, it lends a little bit more credence to the idea that the renewable diesel capacity might operate at a level that is a little bit lower than I would have thought it was going to be 6 months ago or 3 months ago, or really right up until the time that I saw that capacity utilization, at least based on these two different series that have different timings and all of that thing, but still provide a relatively useful guideline, fell to a level that I didn't think it would fall to. All right, so let's look at margins for last week. And for the second week in a row, actually, both renewable diesel and biodiesel margins both moved in the same direction, and that was modestly lower. Biodiesel dropped to 92 cents, which was in line with our forecast. And we expect that biodiesel margins, again, probably remain relatively well supported. Certainly in the short term, it seems that that's going to be the case, but you can see from the chart that we've got them kind of going up here a bit as again, our soybean oil forecast is kind of calling for lower soybean oil prices, but then start to decline as our energy price forecast kind of catches down to what we think is going to happen in feedstocks. Conversely, on the renewable diesel side, we have margins that are probably not super far away from the long-term average, but certainly not at the historic levels that we see for biodiesel. And again, remember that part of this is due to the difference in our feedstock mix assumptions, and that renewable diesel really is reflects margins for fats and greases, and biodiesel reflects margins for using soybean oil as a feedstock, or broadly reflects that. And again, that difference in margins, and the fact that biodiesel margins using soybean oil are so high right now, is part of what sort of contributes to that uncertainty about renewable diesel production month to month, and the relatively flat forecast that we have month to month going forward. Ultimately, it won't necessarily surprise me if that gets raised up a little bit as we see capacity continue to expand. For our RIN price forecast, we did lower it a little bit again this week, not by much, really. I think the model took about $5 out of our D6 forecast, and we took about the same amount out of the D4 forecast, again, just to kind of maintain the outlook for spreads. Spreads have continued to narrow and are getting close to probably the low end of the historical range. Obviously, last year the spread fell to, it looks like, about $7 and $9 here, and we're not super far off of that currently, and we kind of expect that to continue through the end of the year. If we get a bounce or if our feedstock forecast reverses and starts to go from one that suggests lower prices in the coming months to one that suggests higher or substantially higher prices in the coming months, I would suspect that our RIN price forecast would probably follow suit. And given the implications of the weather forecast that we talked about, if that really verifies and continues through the end of August and into September, then it's not hard, I don't think, to make the case that RIN prices could go back and even potentially challenge certainly the earlier 2022 highs, and maybe even the 2021 highs, depending on, again, if how long the hotter and drier weather lasts. If this is a 2-week phenomenon, and at the end of the forecast period, so the middle of August, the weather pattern changes and we start to get a bunch of rain, then we probably are going to be relatively close to our current forecast. If that 8 to 14 and 6 to 10 day outlook continue, especially the 8 to 14 day that really featured really hot temperatures and no rain over the Midwest, if that continues through the end of September, or through the middle of September, then I would suggest that we might go back and test the highs in RIN prices that we saw in 2021. All right, and finally, our LCFS credit price forecast did not change at all this past week. LCFS credit prices were a little bit weaker this past week, and so I probably could have reduced the forecast a little bit. I think maybe we saw a little bit of strength, or at least stabilization, in LCFS credit prices around the CARB meeting. And now that news is sort of been digested by the market, I think that that credit prices have come off a little bit, because there's not something the sort of in traders' faces saying, hey, this program might change and we might be near the lows already. That doesn't mean that I don't think that that credit prices are more likely to stabilize around $90 and then start to rise. But what it does mean is that it probably does increase the downside risk for the LCFS credit price forecast a little bit more than I would have thought it would have last week. I think I probably last week would have thought that we'd get a little bit more follow through in prices than we saw this week, which makes me think that that until CARB either starts to outline in more detail where they're going to go, or there's more steps in the process that get completed, that the market is in sort of wait and see mode before prices start to move higher again. All right. With that, if you have any questions, do the normal, and you can put them in the Q&A or in the chat. And if not, we will get out of here a little early. Somebody is a fast typer. All right. Excuse me. With renewable diesel capacity expected to expand significantly, and thus the demand for UCO and other fats and greases, what steps would you recommend to help a company measure and assess their ongoing ability to source UCO as RD capacity expands? The sales and marketing answer is that you can call me and we can talk about a feedstock availability study, which is something that we have done for several companies. And in that, we would kind of go through and in an area around your facility, we can kind of model what we think the supply and demand is going to be, and talk a little bit about that, and talk about some of the challenges that may be unique to your area. Beyond that, I think that you can probably talk to your suppliers and see if they are willing to enter into more of a strategic arrangement than you may have at this point. I don't know whether they are going to be willing to do that. And UCO is an area that is particularly tricky because the supply, while relatively steady, I don't think is quite as steady or predictable, I suppose is a better word, as it is in some of the other markets. And beyond that, I think in general, a lot of the fat and grease suppliers, at least historically, have liked to keep their sales relatively close in terms of timing, and have not wanted to extend their sales forward in part because of maybe the marginally worse forward visibility that they have compared to somebody like a soybean crusher, let's say. Those are probably the two steps that you could take. You can also probably go through and try to assess the UCO supplies in your area. You can do that, I think, one of sort of two ways. One is a lot more labor intensive than the other. And the first would be to go and try and figure out how many food manufacturers that use soybean oil, or restaurants or sources of UCO are in your area, and try to estimate supplies in your area kind of based on what you think that is, or what you find from that. The second is that you can I think you can estimate used cooking oil production based on population and on sort of at a country level. You can base it on population and per capita GDP. As you start to narrow down into say a 300-mile radius around a specific location, you can start to do it on population and maybe a couple of other variables that would try to mimic the GDP portion of it, or the per capita GDP portion of it. It's not an easy process for UCO by any stretch of the imagination, because while there are some big UCO collectors, there are also a lot of little ones, and then obviously the source point for a lot of used cooking oil, or the source points for used cooking oil, are obviously also a lot of smaller entities that are hard to figure out. But that's generally what I would do. I mean, I think I would draw a circle around your facility and try to estimate UCO, and then on the demand side, really what you're going to want to look at is kind of who are you competing against in terms of biofuel demand primarily, and for UCO, that's really your main source of competition. Do I still feel confident in my UCO predictions? Well, again, if we go back to the fact that there's some relationship between all of these feedstocks, and on some level, the move in soybean oil is going to have an impact on the other feedstocks, and the fat and grease feedstocks probably with a lag. The risks to the soybean oil forecast that I've outlined more broadly apply to UCO as well. I think they're minimized with UCO because of the CI score advantage that UCO has, and the historically high margins, especially for biodiesel, that we're seeing right now. And so what I would say is that at the moment, I'm confident in my UCO predictions, but I still think there is some substantial upside risk for all of the feedstock prices. Not only does the weather outlook suggest that vegetable oil production might be lower or substantially lower than we all thought a week ago or a month ago, but also the fact that UCO demand is also the fact that we've got historically high biofuel margins, biodiesel margins, really good or at least average renewable diesel margins. UCO enjoys a CI score advantage, and so the UCO prices have, while they've come down, they've tended to be a little bit stickier at close to those historic highs that we saw earlier this year. That means that we probably, since we've come down so much, there's room to come back up, even if we didn't have all of that other stuff going on. And because UCO's come down relatively less, maybe that mitigates that bounce back a little bit, or mitigates the upside price risk a little bit. But I think that there's probably broadly upside price risk for the feedstocks, especially if the cut I made to my renewable diesel production forecast is way too aggressive, and in a month or 2 months I come back and tell you that I've had to add 100 million gallons to renewable diesel production, because as capacity has expanded, capacity utilization rates have also jumped, and now we're capacity utilization looks pretty steady around 90%. Conversely, I think from downside price risk, the or things that may mean that UCO prices could start to catch down to soybean oil and some of the other feedstocks. Obviously, as the LCFS credit price comes down, the CI score advantage that UCO enjoys is moderated. And so if you don't get a recovery in LCFS credit prices, or LCFS credit prices continue to fall, then and let's say you get a turnaround in the weather forecast, then maybe UCO needs to play a little bit of catch down to soybean oil and some of the other feedstocks. But I think generally the upside price risk is much more significant for all of the feedstocks than I think the downside price risk is right now. All right, with that, I hope everybody has a great week. Thank you so much for attending, and I will see you all next week.